Something extraordinary just happened in Tokyo that almost nobody is connecting to your wallet. On December 19th, the Bank of Japan raised interest rates to 0.75%. This was the highest level in 30 years. That might sound boring until you realize Japan holds $1.2 trillion in United States Treasury bonds. This makes Japan the largest foreign creditor to the United States. Here is what is keeping Treasury Secretary Scott Bessent up at night. Japan is raising rates while we are dealing with massive deficits and Trump's tariff chaos. This means Japan suddenly has less reason to keep buying our debt. In fact, they might start selling. If Japan sells, the entire global financial system could unravel. Look, I know you have heard warnings about the dollar's demise before. However, this time the numbers are different. According to the United States Department of the Treasury, as of October 2025, Japan held approximately $1.2 trillion in government securities. These were United States government securities. That is not just some theoretical number. That is real capital propping up everything from your mortgage rates to the government's ability to function. Right now, for the first time in decades, Japan has a genuine choice about what to do with that money. Here is what almost nobody is talking about. The dollar's share of global reserves just hit its lowest level since 1994. According to International Monetary Fund data analyzed by multiple sources, the dollar now accounts for around 57% of global central bank reserves. This is down from 72% in 2001. Meanwhile, central banks are buying gold at the fastest pace in history. Gold's share of global reserves has jumped from 13% in 2017 to nearly 20% by the end of 2024. This is not gradual diversification anymore. This is a systematic shift away from dollar dominance, and Japan sits right at the center of it all. Before we dive into why this matters right now, let me show you the three converging forces. These make this moment different from every other dollar scare you have lived through. First, Japan just made a historic monetary policy shift after decades of near zero rates. Second, Trump's tariff war forced Japan into a $550 billion investment deal. This fundamentally changes how they view United States assets. Third, Treasury yields are spiking at exactly the wrong time. Foreign demand for United States bonds is collapsing. When you connect these dots, you see a perfect storm brewing that could fundamentally alter global finance. Let us start with what happened in Tokyo last month, because this is where the story really begins. On December 19th, 2025, the Bank of Japan's policy board voted unanimously to raise the benchmark interest rate. They raised it by 25 basis points to 0.75%. According to the official Bank of Japan statement, this marked the highest level since 1995. Now, 0.75% still sounds tiny compared to American rates, but here is what matters. After 30 years of fighting deflation with negative and near zero rates, Japan is finally escaping the trap. They are normalizing. Normalized Japanese rates change everything about global capital flows. The Bank of Japan was crystal clear about their intentions. In their December meeting summary, policymakers expressed increasing confidence that Japan can sustain a virtuous cycle. This cycle involves moderately rising wages and prices that reinforce economic growth. Several board members warned that delaying further rate increases would pose considerable risk. In other words, more hikes are coming. Bank of Japan. Governor Kazuo Ueda stated explicitly that if economic and price trends align with forecasts, the bank will continue raising rates. They will also adjust monetary accommodation. Analysts at Oxford Economics predict the policy rate will hit 1% by mid-2026. Some estimates range as high as 2.5% for the terminal rate. Now here's where this gets interesting for American investors. For decades, Japan's zero-rate policy created what is called the yen carry trade. Investors would borrow yen at essentially 0%. They would convert it to dollars and buy higher-yielding United States assets like treasuries. This trade pumped hundreds of billions into United States bonds and stocks, helping keep American borrowing costs artificially low. However, when Japan raises rates, that trade unwinds. Suddenly, borrowing yen costs real money. The math changes. All that capital that flowed into United States markets starts flowing back home. We've already seen glimpses of what happens when the carry trade unravels. Remember the market chaos in early April 2025 when Trump announced his reciprocal tariffs. According to reports from multiple sources, approximately $20 billion worth of United States government bonds were sold. These sources included Bloomberg and the Financial Times. This happened in just a few trading sessions. The 10-year Treasury yield spiked to 4.592%, marking the largest weekly increase since 2001. Japanese pension funds and banks were among the largest sellers, rebalancing portfolios as United States stock losses mounted. That was just a preview. But wait, you might be thinking, Japan did not actually increase its Treasury holdings recently. You are right to question that, because the narrative is complicated. According to United States Treasury Department data released in late February 2025, Japan held $1.079 trillion in treasuries. This was as of January 2025. The amount was actually up from 1.059 trillion in December 2024. So they were buying, not selling, in early 2025. But here's the critical context. Those purchases came before the December rate hike. They came before inflation in Japan became entrenched above 2% for the fourth consecutive year. They also came before the yen started strengthening. The real story is not what Japan did 6 months ago. It is what they are positioned to do now. Multiple sources confirm that Japan's finance minister, Kato Katsunobu, recently suggested something. These sources included reports from The Diplomat and Nippon.com. He suggested that Japan's United States debt holdings could serve as a strategic card in trade negotiations with Washington. This marked a dramatic shift from previous positions, where Japan explicitly avoided linking bond holdings to trade discussions. Think about that for a moment. Japan's own finance minister is publicly acknowledging that their treasury position is now a strategic lever. That is unprecedented. Now let us talk about Trump's tariff deal, because this is where geopolitics and finance collide in ways most analysts are missing. In July 2025, after months of tense negotiations, Trump announced what he called a massive trade agreement with Japan. The framework was simple but extraordinary. Japan would invest $550 billion in United States strategic sectors, everything from semiconductors to energy to shipbuilding. In exchange, Trump would cap tariffs on Japanese imports at 15% instead of the 25% he had threatened. According to the Memorandum of Understanding finalized in September, these investments must be completed before January 2029. Here's where it gets wild. The deal gives President Trump near total discretion over how those $550 billion get invested. An investment committee chaired by the Commerce Secretary recommends projects, but the White House makes final decisions. According to the profit-sharing terms, the United States receives 90% of returns. Japan essentially agreed to become a massive piggy bank for Trump's industrial policy, with American officials controlling the purse strings. As one legal analysis from Just Security put it, this creates a $550 billion slush fund. This fund operates outside congressional appropriations. That is 8% of total federal spending in fiscal year 2024. Now, why would Japan agree to such lopsided terms? They were terrified of the alternative. 25% tariffs would have devastated Japan's economy. Auto exports to the United States make up 28.3% of all Japanese shipments, according to 2024 customs data. Toyota, Honda, Nissan, Mazda, all of them would have faced catastrophic losses. When Trump announced the deal, Japanese auto stocks surged. Honda jumped over 8%. Toyota climbed above 11%. Mazda rocketed 17% higher. The Nikkei 225 gained more than 2% in a single session. Japan's top trade negotiator literally posted the hashtag mission accomplished on social media. But here's what that celebration obscures. Japan just committed more than $500 billion to projects they do not control. Profits mostly go to the United States government. This is happening in an economy where they are trying to bring capital back home. Their goal is to support rising interest rates. Think about the contradiction. The Bank of Japan is raising rates to attract capital and strengthen the yen. Meanwhile, the government is shipping $550 billion to America. These two policies are fundamentally at odds. When push comes to shove, which one wins? My money is on the central bank. This brings us to the Treasury market itself. This is where things get genuinely concerning. Foreign ownership of United States treasuries has been declining for 15 years straight. According to J.P. Morgan Research, foreign investors held 50% of the Treasury market during the global financial crisis. As of early 2025, that figure has plummeted to just 30%. Think about what that means. 70% of United States government debt is now held domestically. This sounds fine until you realize domestic buyers have limits. American banks, pension funds, and investors can only absorb so much. With the federal deficit exploding and debt issuance accelerating, we need foreign buyers now more than ever. The numbers are stark. 10-year Treasury yields have been volatile throughout 2025. They have traded in a range between roughly 4 and 4.6%. According to analysis from T. Rowe Price published in January 2026, inflation expectations hit 2.4%. This was measured by the 10-year Treasury inflation-protected securities break-even rate. This figure is well above the historical 2% norm. That is partly driven by fears that Trump's tariff and immigration policies will drive persistent inflation. Real yields on 10-year Treasury inflation-protected securities were running at 2.15% as of late January 2026. When you add those components together, you get upward pressure on nominal Treasury yields. This means higher borrowing costs for everything. Here's the feedback loop that should worry you. Higher Treasury yields mean the United States government pays more interest on its $38 trillion national debt. That means larger deficits. Larger deficits mean more bond issuance. More issuance without sufficient foreign demand means yields have to rise even further to attract buyers. It is a vicious cycle. Japan's potential withdrawal from the market accelerates every turn of that wheel. If Japan shifts even 10% of their holdings, that is $120 billion of demand that vanishes. Somebody has to fill that gap, and it will not be at the same price. Let me show you how this connects to the broader de-dollarization trend. Japan is not making these decisions in a vacuum. According to Federal Reserve analysis published in July 2025, the dollar comprised 58% of disclosed global official foreign reserves in 2024. That is down from 72% in 2001. Here is the key detail. The dollar's share is essentially unchanged since 2022. For the past 3 years, its share has plateaued around 58%. However, the composition underneath is shifting dramatically. Central banks are not moving to the euro or yen as alternatives. Instead, they are diversifying into non-traditional currencies, and most importantly, gold. Gold purchases by central banks have exploded. According to JP Morgan research, emerging market central banks have been the largest gold buyers over the past 10 years. These banks are led by China, Russia, and Turkey. The share of gold in emerging market foreign exchange reserves has doubled from 4% 10 years ago to 9% now. Developed market central banks hold an even larger share at 20%. Prices also reflect this demand. Gold is forecast to climb toward $4,000 per ounce by mid-2026, up from current levels. When central banks buy gold instead of treasuries, that is dollar demand that is permanently gone. China provides the perfect case study for what Japan might do. China was the largest foreign holder of United States treasuries for years. However, they have been systematically reducing their position. According to United States Treasury data, China's holdings dropped to $760 billion as of December 2024. This is down from over $900 billion in September 2022. That is a decline of more than 15% in just over 2 years. Meanwhile, China's central bank purchased gold for 11 consecutive months through mid-2025. This increased reserves to 74.06 million fine troy ounces. These reserves are valued at $283 billion. If you are finding value in this breakdown of how Japan's treasury holdings could reshape global finance, hit that like button. This situation is evolving by the hour, and I am tracking every development. Japan is not China. Japan is a close United States ally with deep security ties. According to Federal Reserve research, about 3/4 of foreign government holdings of safe United States assets are held by countries with military ties to the United States. Japan is not going to dump treasuries overnight as some kind of hostile act. However, here's what they might do. This is almost more dangerous. Japan might just stop buying. They might let their holdings mature without reinvesting. They might very gradually and politely reduce their exposure over years while maintaining the alliance. Think about Japan's strategic calculation. Japan faces an aging population and sluggish productivity. They need every yen to support domestic infrastructure, pensions, and economic growth. With interest rates rising at home, Japanese government bonds suddenly offer competitive returns. 10-year Japanese government bond yields hit their highest level since 1999 after the December rate hike. These yields climbed above 2%. 30-year Japanese government bond yields are at levels not seen in over 20 years. For the first time in a generation, Japanese investors can earn meaningful returns at home without taking on foreign exchange risk. Why send money to the United States? There is also the geopolitical angle that nobody wants to say out loud. Japan is caught between its largest trading partner, China, and its security ally, the United States. Trump's tariff policies and unpredictable trade approach have created enormous uncertainty. An analysis from Nippon.com noted that Trump's unprecedented trade policies are bringing new uncertainty to the international commerce system as a whole. Japan needs strategic flexibility. Having $1.2 trillion locked up in United States treasuries is not flexibility, it is vulnerability. If United States-China tensions escalate further, Japan needs room to maneuver. Diversifying away from dollar assets gives them options. So what happens next? Here are the key dates and events to watch. First, the Bank of Japan's next policy meeting is scheduled for January 22nd through 23rd, 2026. They will update economic and inflation forecasts. Markets will be watching for signals about the pace of future rate hikes. If they sound hawkish, expect more pressure on the yen carry trade. Second, watch Japan's spring wage negotiations, the shunto, in early 2026. The Bank of Japan has explicitly stated that wage-setting behavior is central to sustainable inflation. If wages jump again like they did in 2025, it confirms the normalization trend. This means more rate hikes are coming. Third, monitor United States Treasury auction results, particularly for longer-dated bonds. If demand weakens, or if the Treasury has to offer higher yields to attract buyers, that is your signal that foreign appetite is fading. Fourth, pay attention to the dollar-yen exchange rate. Despite Japan's rate hike in December, the yen actually weakened against the dollar initially. The United States dollar-Japanese yen jumped to around 157. However, analysts at ING and other institutions expect moderate yen appreciation over 2026, as rate differentials narrow. If the yen strengthens significantly, it makes Japanese investors even less likely to buy dollar assets. This situation is evolving by the hour. The mainstream media is barely covering the real story. They will tell you about tariff deals and trade negotiations. However, they will not connect it to the Treasury market and what it means for dollar dominance. Subscribe and turn on notifications so you do not miss emergency updates as this unfolds. Here's the bottom line. Japan's $1.2 trillion Treasury position is not just a financial statistic. It is a geopolitical weapon. For several decades, Japan has chosen not to use it. With interest rates rising at home, capital needs are increasing. Trade uncertainty is mounting and alternative investment options are improving. That choice is no longer automatic. The dollar's reserve currency status is not going to disappear overnight. As Goldman Sachs asset management analysis confirms, the dollar still accounts for approximately 58% of global reserves. This is far ahead of any competitor. No viable alternative has the scale, liquidity, and institutional trust to replace it. The euro has its own problems. The yuan faces capital controls and transparency issues. Gold lacks transactional utility. However, dominance does not have to vanish completely for the consequences to be severe. If the dollar's share drops from 58% to, say, 45% over the next 10 years, that is trillions of dollars of demand evaporating. Treasury yields would spike, borrowing costs would explode, the federal deficit would become unsustainable. And Japan holds the keys to how fast that happens. Every time they choose not to roll over maturing treasuries, the timeline accelerates. Every time they buy Japanese government bonds instead of United States bonds, the pressure builds. Every time they shift even a small portion of reserves into gold or other assets, the message gets louder. The dollar's monopoly is ending. The transition might be gradual. It might be orderly, but it is happening. The biggest test of the dollar's dominance is not coming from China, Russia, or some BRICS payment system. It is coming from our closest ally in Asia. This ally is simply doing what any rational actor would do, acting in their own economic interest. What do you think happens next? Will Japan continue propping up United States debt markets? Or will they prioritize their domestic economy and let Treasury holdings decline? How low can the dollar's reserve share go before we see real economic consequences? Drop your prediction in the comments. I read every single one. The insights from this community are often better than what you will find in mainstream analysis. Remember, if you are a long-term investor, a trader, or just someone trying to understand how the global economy actually works, this Japan Treasury dynamic is the story to watch in 2026. Everything else, all the headlines about inflation and Federal Reserve policy and tariff negotiations, it all flows through this one critical relationship. Thanks for watching. If you want to dive deeper into how global capital flows are reshaping the financial system, check out the video in the cards. There, I break down exactly how central banks are abandoning treasuries for gold and what that means for your portfolio. See you in the next one.